Okay, hello everyone. Welcome to KOPI with CapitaLand. Very happy to see everyone here. I have to say it feels great to be back in a physical event after spending maybe 2 years in front of a laptop. I'd like to first introduce our speakers for today. We are very happy to have with us the senior management of CapitaLand Investment. First, on my immediate left, the Group COO, Mr. Andrew Lim, and the Group CFO, Mr. Paul Tham. So for those who are not familiar with this event, KOPI with CapitaLand is an opportunity for you to engage with our senior management, ask questions, especially if you have seen our recently published annual report ahead of the AGM, which we are having on the 25th of April. There are a few parties I'd like to thank. I'd like to thank SIAS for sharing this event with your members. Thank you also to Mr. Vincent Tan for helping out with the invitation process. Before we begin, I'd like to give you a rundown of today's event. So we will start with a short presentation by Paul on our business and a recent performance. This will then be followed by a Q&A, which will form the bulk of today's event. We will then adjourn. We prepared some food for a quick bite at 12:50, between 12:50 to 1. And if you remember from your email, we've actually mentioned that we have a special tour of the Citadines property after lunch, after food. So that will be at 1:30. I'll give you more instructions on where to meet later on. And before I invite Paul for the presentation, can I remind you to leave your questions for the Q&A session after this presentation? So without further ado, I'd like to invite Paul up for the presentation. Thank you. Paul, please.
Thanks, Jeremy. Okay. Well, good afternoon, everyone. It's a pleasure to be here. I haven't had a SIAS event, at least for me, for some time. So this is very nice. It's good to see familiar faces as well. So thank you all for coming. Hopefully you all will stay for lunch after this. As Jeremy mentioned, we do have time set aside for Q&A, but honestly, please feel free as we're going along in the presentation to just ask questions. Just raise your hand and feel free to ask as we go along. So I'm just going to share just some brief highlights, particularly on last year's results. We are coming up to our first quarter results next month. But this would be our most recent set, so this really covers the full year, and just to share a little bit what has been going on for us. Okay, a little bit slow moving. Okay, so just at a high level, a little bit of highlights for us for financial year 2022, and how did it really look? As all of you, I'm sure, are very aware, so I won't spend too much time on this. Last year was a pretty challenging year. I think first and foremost, we really had high inflation. We felt that in Singapore, but really in all parts of the globe, we've really felt that, and that impacted us in almost every market, with probably the exception of China, in terms of inflation pressures and interest rates. And with those interest rates movements, the impact to us was twofold. One was it actually made it very challenging for us to do deals, because a lot of people were waiting on the sidelines, right? When they were looking at potentially buying or selling buildings, a lot of them were concerned on where interest rates would go. And so even though there were opportunities that we looked at, there was still a big divide between buyers and sellers on what were the right opportunities. And then obviously with interest rates going up, that's been pushing costs up for us as well, both for ourselves and our 6 listed REITs. Fortunately, this year looks like it's slightly better. We expect at least interest rates are going to stabilize. Hopefully second half of this year, we see that flattening out. This week, we're waiting for some data out of the US, and then obviously Singapore as well later this month to see how this moves out. So our hope is that at least for the rest, or at least the second half of this year, we'll see a little bit less inflation and interest rate pressure on us. Obviously, the other 2 big moves was geopolitical tensions, really particularly for us, tensions between the US and China. That had an impact on us in that part of our business is really raising funds to invest in China. And with, I think, general hesitance about China last year in particular, a lot of US investors or European investors or Canadian investors who normally would invest with us to go into the Chinese market last year were much more cautious. We're starting to see a little bit more signs this year of some of that coming back. And earlier this year, we launched 2 funds focused on China from money outside of China. But this used to be a much bigger component of growth for us. And the original strategy would be that would grow. So, that geopolitical tension certainly hasn't helped us in terms of growth. And we've had to pivot and really look at growing domestic capital. So really raising local Chinese money for Chinese investments. So that's a little bit of a change for us. And then the last, how did I get there? And then the last thing, obviously, that happened last year was really a zero COVID policy in China. And as most of you know, we have quite a number of malls in China, either through our REITs or our funds or directly on our balance sheet. And so that had quite an impact on us just directly in terms of numbers. We gave about 1.5 months of rebates to our tenants. Because similar to Singapore, when there was a lockdown, the shops were shuttered and people were not coming. And so we had the same situation in our malls in China. So, all of this did impact us a fair bit, especially in terms of our financial numbers. We're hoping this year will be better with inflation costs and rising interest rates slightly better. And hopefully China being past COVID and having opened up. So in terms of what that meant for us, maybe just as a chance to explain a little bit, because we take this question a fair bit from a lot of our investors, how do we generate income for CLI? Now that we no longer develop, we no longer sell properties, what are our main income drivers? So we really look at it internally in our business in 3 ways. On the top left, you'll see what we have as our fund management business. And this is the part that we are really focused on. This is our listed REITs and our private funds. And so when we talk about a funds under management number, it really relates to that top left fund management business. And from this, we earn our revenue by charging fees for managing funds. Whether they're private or public, we're a little bit more agnostic to that. But the goal is to grow the funds under management. We're currently at about 88 billion. So we grew. I think one of the questions we received was, where has the growth been? Really, last year, we grew 2 billion in Australia. We grew 2 billion in China. We grew another billion in Singapore. So it's been a little bit spread out in terms of where that growth has come from. But we are expecting this to continue to grow, whether from new private fund launches or potentially, hopefully down the road as well, growth from our REITs or even new REIT listings. So on the top left, what we call our lodging management business. So you would have seen the signs when you came up. Obviously, there's a Citadines service residence here. So our lodging management business has a number of brands: Ascot, Citadines, Oakwood. We manage about 800 plus hotels or service residences. And so we earn a management fee for managing the hotels or service residences. Well, we only own on our balance sheet or as a broader portfolio, we only own about 10% of those. So 90% of them are actually owned by other companies or individuals, and we earn a service fee from them. So we think of the top 2 really as our fee drivers. When we talk about fee management, it encompasses these 2. And then there's the one at the bottom, which is a little bit more traditional for us. This is ownership stakes in real estate for us. So we call this our real estate investment business. It comes in 2 forms. One is, and most of you know quite well, we have large stakes in a number of our REITs. So for instance, we have 22% in CapitaLand Integrated Commercial Trust that owns this building. And when they earn a proportion of that income, so say if they earn $100,000 for this month, we own 20%. So we will attribute 20% of that income into this real estate investment business. And so our ownership stakes in the REITs and the funds actually contribute 70% of the income we get from this real estate investment business. So if you are following our stock and trying to understand what our forecast will look like or how much income we're likely to generate from this part of the business, it really comes from, if you understand our REITs and our holdings in them, you get a pretty good sense of how this part of the business will perform for us. The other 30% on this real estate investment business are assets that are still on our balance sheet. So for instance, we still have 50% of Ion Orchard on our balance sheet. We have some assets in the US, we have some assets in Europe, and in China. So that makes up the remaining 30%. So it's still a minority, but we consider that part of the real estate investment business. So generally for last year, we had good growth for both the fund management and the lodging business. Lodging had a great recovery last year, and our fund manager business managed to grow. So about 9% overall growth in the revenues for the fund business. I think where we struggled was really on this bottom real estate investment business component. Partly the rental relief in China, giving up those rebates, that hurt our numbers. Some of our REITs and trusts did do better, which helped offset. So CapitaLand, Ascendus REIT did better last year, so that helped improve. But in overall, we were still down slightly because of some of the relief in China. Also because we didn't sell as many of the assets on the balance sheet. So that's the other component for us on the real estate investment business. We sell the assets we have on our balance sheet. As you know, we sell them either into the REITs or we've been selling them into the funds. The idea is to bring the ownership stake down for us. We want to be asset light. We're trying to improve our return on equity. So last year we divested 3.1 billion, which was in line with our target. But for those of you who followed us the year before we divested about 13 billion worth. So there was a big drop. That was partly market. And so we're hoping this year to try and improve on that. So I won't go through in detail very much on the rest of the slides. I think a number of you are familiar with our REITs and our funds, but maybe just some high-level things. We have 6 listed REITs. I think what we were proud on really last year was really the bottommost line on this slide was the DPU growth. For our REITs that we own, I mean, our main focus is making sure that DPU and share price grows, right? As the largest shareholder, we like seeing that too. It helps our cash flow and it helps our growth in the business. So we saw that growth. I think most of you would probably want to know what's going to happen going forward for the REITs. It's a high interest rate environment. It's harder for us to grow the REITs business right now. So this has been a wonderful contributor for us in that it's very stable income as a fund manager. Unfortunately, growth in high interest rates times is actually quite challenging for us. We do expect it will be able to, and we'll see some of the REITs hopefully do acquisitions. I'm not sure if any of you are shareholders, but our Malaysian REIT, CapitaLand Malaysia Trust, did do a fundraising earlier this year. So they're listed on Bursa Malaysia, so a little bit less relevant to here, but they did actually see some growth. So our hope is that for some of the REITs, we will see some growth this year. On the private funds side, and so these are generally for us, our private funds at this stage, we are not at the point where they are open to ultra high net worth or retail investors. Right now, our private funds are really just institutional investors. So people like GIC, Canadian Pension Fund, these would be the type of investors we target for our private funds. So last year, for our private funds business, as I mentioned, it was a bit challenging because of the environment. It was harder for us to raise some money, particularly for China, which is one of our main markets. So what we did on the left-hand side is we raised 3 renminbi denominated funds. So this tapped on money from insurance companies in China, such as, say, Ping An Insurance, some of their state-owned enterprises and security companies. And that helped us to raise almost $1 billion to invest in Chinese assets. So we like this because with all the geopolitical tension going on, we don't have to take the money out of China. We don't have to worry about bringing money in. All of this is within China itself. So this is part of the business that we would like to see grow. Similarly, in Korea, we had 2 new funds, so smaller funds, but our Korea team is doing a great job and we're starting to see growth. So they've been investing in logistics, in data centers, and the Korean market is similar to the Singapore office market, which is one of the strongest office markets in the world. The Korean office market's actually arguably stronger than the Singapore one right now. They are at lowest ever occupancy rates. So we're seeing good growth from the Korean team as well. And then for Southeast Asia and lodging, for a lot of private fund managers, what you do is you have very big, what we consider core funds or value add funds. Right? So core funds are very similar. They're a private version of a REIT vehicle, effectively, or value add looks at more value enhancements. So it targets a higher return. In the current environment, it's been quite tricky to raise money for these general funds. So what we did last year was we targeted niche plays. So for instance, we did a lodging fund last year. Those of you who have followed, we did a self-storage fund. We did a Southeast Asia logistics fund. They're good funds in the sense that there are always people who believe in certain asset classes and who will come in with you for it. I think the downside for that is it's harder to raise a very big fund. So it was a little bit of a balance. Just given the market conditions last year, we felt we would do a number of targeted funds, and that's what you see on the right-hand side. And then on our lodging business. So our other fee generating was really lodging. Lodging had a great year, our best year actually for lodging last year. Revenues were for us were up 36%. In terms of fee income, and that came from two things. One is we signed a lot more units. So our lodging team has gotten a lot more momentum. People like service residences more. Particularly during COVID, service residences did very well because they have a lot of long stay. Average stay in one of our service residences is 1 to 3 months. So it provides much more stable income. And they've gotten good traction. And what we've seen is they've hit 159,000 units. So for service residences, we call them units because there are multiple bedrooms. So unlike the hotels, which they use number of rooms or number of keys, we use number of units. It's a little bit unusual. Actually, we don't see a lot of players using this terminology in the market. That's why we try to explain it. So that's why we do it as revenue per unit. And so last year, with the opening up post-COVID, they really saw revenues jump up, particularly in Europe and in Singapore, and places like the Citadines here. Very often, actually, we find the Citadines here almost entirely fully taken up. Occupancy can go up to 95 to 100. So last year was a very good year for lodging. Our hope is to continue to see it grow. We do have some new products. So for instance, on the top right, and I think some of you have visited before, we have our Life product. This is targeting younger folks. This is for co-living. We have one in Funan. We have one in Buona Vista. If you haven't seen them, please feel free to reach out. And whenever we do institutional or retail investor visits, we're happy to have you guys come and visit and see them. I think what you will realize when you see some of these is the rooms are really tiny. And honestly, I don't know who would stay in that, but somehow they do really well. And we get a much younger demographic that has been staying there. So this product is doing well, and we're hoping to be able to scale this. And then that takes me to our PATMI numbers. So the previous slide was just on our revenues, which ties to this slide. So we look at our PATMI, or our profit after tax and minority interest. So we look at our profits through 3 buckets. The first is operating PATMI, which is the bar chart you see all the way on the left. Operating PATMI for us is generally the recurring revenue component. So either from the fee income or our ownership stakes in the REITs, we consider that to be our operating base. So what was encouraging is we saw operating profits go up, right? And this ties to how our cash flows are doing, how much we're comfortable paying in terms of dividend, and how we look at our stable business. So that part, fortunately, went well. I think the 2 parts where we really faced trouble, so you can see the big drop-off, was one on portfolio gains. Portfolio gains for us is divestments. When we sell a building, if we sell it above book, we mark it as portfolio gains. So it's only realized portfolio gains. And as you can see, we had this big drop-off year on year, and that was really driven by China for us. The year before, when we divested 13 billion worth of assets, a lot of that we managed to get the profit and mark it up. Last year, when we dropped our divestments to only 3 billion, that profit number came down quite a fair bit. I don't think we will necessarily ever get back to, or at least not in the near term, back to divestment level at that 600 million, because we don't have that much assets left on the balance sheet. We have probably about 10 billion worth of gross asset value. But we do think, hopefully over time, we can come off, or at least for the next 2-3 years where we're divesting, where we hope to be able to outperform last year. And then the last, or that third column, is on revaluation and impairment. And this is the unrealized component. This is, as you would have seen, particularly from our REITs, where it's more obvious, this is the markup or down on the property values. So we do recognize. So this is non-cash for us and goes up year on year or down year on year. So last year, the portfolio overall was flat. We saw the Singapore side valuations increase. We saw some of our US multifamily increase in valuations, but China valuations drop, Europe valuations drop, and net, it came out to just about flat, so 30 million in profit. I think this year could be potentially challenging for us. With higher interest rates, we think a lot of valuations will be under pressure. So we We'll still see, we still think that some markets will still see improvement, but overall we think the environment's quite challenging for at least the revaluation component. And then if you sum those three bars up, you get the bar all the way on the right, and that's why you see the big drop-off for us. While operating profit went up, unfortunately we were not able to make up the change in the other two. So tied to our profit number is our dividend. As most of you, if you're invested with us, you'll know when we announced a full year dividend for us, we have two components. We have what we call our core dividend, which was 12 cents last year. The year before was also 12 cents. And I think for us, when we look at this dividend, the year before the results were very strong. So we were very comfortable with a 12 cents plus a special dividend of 3 cents, which came up to 15. The 15 cents was also partly because, I think for those of you who have been our investors for a while, the year before was during COVID, we dropped it to 9 cents. So we wanted to make up for it the year before. So we went to 15 cents. This year, we've kept it at 12 cents for two reasons in terms of the cash dividend. One is our profits went down, so we didn't want to move that dividend up. But because our operating cash flow actually increased, so because of the higher recurring income, our operating cash flow went up, so we were still comfortable with maintaining that 12-cent dividend. The other component to our dividend was, for those of you who have us, we distributed CapitaLand Ascot Trust shares, or we will be distributing. We've announced the distribution in species. And the reason we did this is actually more of a capital management exercise for us. It wasn't, we are happy to share this with shareholders and distribute out so that everybody can get a little bit of the lodging upside, because we're still very positive on lodging. It isn't something that we are looking as a long-term to be distributing in species units. We held 37.5, or we hold 37.5% of CapitaLand Ascot Trust. For our 4 other Singapore REITs, we hold between 18 to 23%. In that range. We feel our appropriate holding level is below 30% and more in that 28% range. So by distributing the CapitaLand Ascot Trust units, it brings us to just below 30%. So we'll be at 29%. We're not intending, for those of you who have CapitaLand Ascot Trust units, we're not intending to do another distribution in species. We're comfortable with our holdings. We think naturally as the REIT grows, we'll probably dilute over time. But we're not planning to do another exercise on those units. So that's how we came up to that. So it turned out, because of the quantum that we wanted to distribute, it came up to almost 18 cents. And I think going forward for us, our expectation is we should be generally able to maintain our core cash dividend of 12 cents. I think the special distributions are really dependent on circumstances. For instance, if we have a very outstanding year where we are able to divest a lot of assets or profits are very good, then we may look at changing that. But otherwise, that's a level we're quite comfortable with. And then the last slide is just share price, which we always include in the material. Fortunately, our share price has held up pretty well. Obviously, for us, this is a little bit of a fingers crossed, touch wood, that it stays up there. But this is something that we look at very closely as well. I think from a management perspective, obviously we are quite invested on a share price viewpoint as well. And so this is something that we follow as well. And then just to give you a very quick outlook, I won't cover the 2022 recap because we talked about a lot of that. But in terms of 2023, we'll spend a bit more time, I think, in terms of Q&A on the 2023 component, is really what's our outlook for the year. I think generally right now, the 4 main things when we wrote this in February, one is we still expect that we'll be able to grow and hit our target in terms of funds under management of reaching 100 billion. But circumstances are still quite uncertain. It's still challenging interest rate and macroeconomic environment, so that will have some impact on us. China's reopening has been pleasantly faster than we were originally expecting. So we've been able to launch a couple of China funds earlier this year, the China Special Situations Fund and a China Data Center Fund. And we're hoping to, maybe not so much in the first half, but we hope by the second half of the year, we'll see some good improvement in terms of China numbers. Third bullet point, lodging. Fortunately, lodging is still doing well. We thought we may see a little bit of slowdown. Our worry was that there may be a recession, particularly in Europe and the US, and we may see a bit of a slowdown. But surprisingly, lodging is still doing decently well in those markets. And in Asia, with China reopening, we actually expect a little bit more momentum for our lodging business. And then the last bit is we're going to continue to look to divest assets and try to improve really our return on equity for investors. And that's really our outlook for the rest of this year. And so maybe with that, we can go to questions.
Thank you, Paul. Thank you, Paul, for the insightful presentation. So we'll now move on to the Q&A session of today's event. Just some house rules. If you would like to ask a question, please raise your hands. My colleagues will come to you with a microphone. But can I also request that you maybe just state your name so that we know how to address you when we answer your questions? But actually, I've got a question for Andrew. Andrew, you've just assumed the role of Group COO in December last year. Could you tell us a bit more about your new role and what you will be focusing on?
Thank you, Jeremy, and it's great to see everyone again. It's always a pleasure to meet our supporters and long-term shareholders. So the COO role is actually a role that we haven't used at CapitaLand for some time. But we felt that it was important to re-establish the COO role. And if I were to describe my principal responsibility, it is as follows. Those of you who know us will know that we've reorganized ourselves into 4 principal fee income products, right? So you've got your REITs, our public funds. Then we have our private equity real estate, Simon Tracy. We've got private equity alternative assets under Patrick Bucock. And then obviously we have lodging under Kevin Goh. So these are our 4 principal products that will seek to grow fee income, which is our primary rice bowl going forward. Now, supporting the 4 products are all of the countries that we do business in, right? So we've got 3 core markets, China, Singapore, India. We've got 3 focus markets, Japan, South Korea, and Australia. All of these 6 countries are in Asia Pacific, which is our principal area of operations. We want to be Asia Pacific's leading REIM in 3 to 5 years. And then we have a meaningful presence in Europe and North America. So these are our geographies that we are present in, and we have strategies in each of these geographies to support the 4 products. So my role really is to look after the countries to ensure that each of our countries work closely with the 4 product vertical heads so that our strategy can be realized and as we grow the business as a fee income capital manager, fee income earning capital manager. So that's how I see my role. I'm essentially the guy who goes around the world making sure all of our countries understand their responsibilities, their accountability to each of our product partners, whether it's CICT in Australia or Germany, whether it is CLAR in the US, whether it is CLAS in Europe, in China, in Japan, and so on and so forth. All our private equity products that are also ramping up. Each of the countries have to support these products, otherwise they will not be able to fulfill their mandates and generate the fee income that we are underwriting on behalf of our shareholders at CLI. So it's a partnership between countries and products, and my responsibility is to ensure that the countries hold up our end of the bargain.
Thank you, Andrew, for enlightening us on your new role. So I see Vincent Tan, so maybe we kick off with your view for the first question. Can we have the mic?
Hi, I'm Vincent. Could I have the slide on lodging management where yeah, so I thought this is interesting. It's supposed to be the one that's driving a lot of the growth now, and also that apart from other REIMs, you are the only one probably with a lodging management. So maybe it's a good place to start to learn something about your business model. So I think you have been growing very fast. 33,000 you said in 2022, and you're reaching 159. Your target was 160. You're almost there. But I am trying to understand this business more. I think during the restructuring part, I think Andrew guided that for every 10K units, you probably will be able to make like 20 to 25 mil generate FRE of that kind of scale. So if we take 159, we minus 33, we get probably about 126, right? And then if we take 12.6 times the 20 million, it probably comes out to that kind of figure, right, that you are guiding. So I'm trying to understand, you're almost at 159, 160. So is this growth reaching saturation, and will it increase? And as it increase, do you have the effect of scale so that actually you can go from 20 to 20, from 20, which is a lower figure, to 25 million per 10K, that kind of figure? So trying to understand this, because as part of the question, I'm also trying to understand, let's say when you take on Oakwood, right, from Mapletree, you get 15,000 units. And what is your consideration that you're paying to kind of like get those 15,000 units? And how do you see this kind of, how do you do the risk-reward calculations on all this? Because for me, investing in CLI is about scaling. Yeah. As compared to previous CapitaLand, right? The fact that previously CapitaLand, the ROE was just like, the most you could get was about 8%. But I'm asking a lot of questions, but partly because of COVID and all that, right? The ROE now is 5.5%. It's actually lower than the 8% the previous year. So we have this contrasting thing that is going on, where our ROE is actually worse than Ming years when Ming was running the show, and Chee Koon actually has a higher target than that. So try to bring us into your frame of mind on how you are seeing all this, and whether this scaling and all that, how this business model is will play out in the future years when things are no longer as stressed due to COVID and that kind of space.
Oh, go ahead.
Okay, there's a lot to unpack. You touched on a few important themes, Vincent. So one is business model and scale. The other one is FY22 results. So it's important, I think, to make a distinction between the two. And Paul, I hope, has clearly demonstrated what happened in FY22 that caused us to underperform our own expectations and deliver a 5% ROE. I can tell you that when we set out the 22 budget, the target ROE was not 5. The target ROE was much closer to what you have come to expect from CLI. Okay. But because of what happened, China, recycling, COVID, a lot of the issues that China presented to us caused us to undershoot. So if you will, I would submit to you that the 5% is not a business model issue. The 5% is a FY22 issue. It's because of what happened in 22 that caused us to undershoot. The business model is something that takes 3, 5, 7 years to fulfill. And you talked about a couple of very key themes. One is scale. When you are dealing with fee income, the name of the game is scale, right? And Paul is very familiar with this because Paul comes from a background and has come in to remind us that whenever we think about issuing new products, it's not just enough to say we want to issue 5 new funds. If I have 5 new funds, but each fund is only about 200 million in size, it is not as exciting. So like 1 billion in FUM. It's not as exciting as one fund with 1 billion or 1.5 billion. The scale is what drives the profitability. And I think many of us can understand this concept. And that applies very much to lodging management. Because if the reason we bought Oakwood and the reason Mapletree was willing to sell Oakwood to us is because Oakwood did not fulfill their scale aspirations. They couldn't grow it as quickly as they needed so that they could overcome the high fixed cost base, the fact that your technology requirements for hospitality are high and technology is expensive. When you are building in platforms that allow you to check in seamlessly, check out, receive your make your bookings online and all that kind of stuff costs a lot of money. And you have to constantly upgrade it. So if you can't roll that out amongst the 160,000 keys, you can only roll it out amongst 15,000 keys. Your cost per key of the technology is through the roof, much higher than what we are able to deliver. And therefore the margin is not there. So from our perspective, in acquiring something like Oakwood, we saw that we can instantly, by absorbing 15,000 keys in, we can reduce their per key amount or cost from Oakwood's accounting to CLI accounting just by virtue of the fact that you're coming into a ecosystem that has 160,000 keys. So the ability to get Oakwood to a more profitable position instantaneously improves. Then obviously it becomes a willing buyer, willing seller. Can I take this headache off you? And we agree on a fair price. And thankfully and graciously to Mapletree, they agreed that this makes better sense for you to manage. So we agree on a fair price and we transact. Now, what that fair price is, we didn't disclose, and it will remain undisclosed. But we are very happy with our acquisition. And if you see the Oakwood trajectory now, at AGM, please feel free to ask Kevin this. We are excited about what Oakwood would bring to our trajectory, particularly in high travel markets like Japan and Korea, where Oakwood actually is a better brand than Ascott in Tokyo and in Seoul. And anyone who's been to Tokyo recently, the hotels are full. I was just back from Tokyo last week. Ascott Marunouchi, 100% occupancy. And our underwriting RevPAR is 3 times lower than what we are achieving now. So what we thought is break even, or what we were comfortable underwriting Marunouchi at, we are now delivering more than 3x above that on an average room rate basis. Now, it may not always be this way, and we all remember the dark days of COVID, right, when hospitality was not even at underwriting. We could struggle to get 40% occupancy. But the model proved to be resilient, and now we are in a position where the steps we took to preserve the ecosystem, the owners are very happy about the resilience of the product, and now we have a nice tailwind into a product which, as you say, very few other people have. So I think we are a bit lucky to be good and good to be lucky that we took the decision to keep Ascott within CLI and to position it to our shareholders to say this is a viable, relevant fee income product vertical that we think differentiates ourselves from other REIMs. Now, it was tough going during COVID, right? It was an anchor. But now I think that the shoe is on the other foot, where it becomes a tailwind for us and is driving share price resilience because people see, okay, your core product maybe not doing so well, got headwinds because your REITs cannot acquire as quickly. You are struggling to find good core returns. But on the other hand, we've got lodging that is doing really well and keeping it up. So it goes back to the virtues of having a diversified REIM model. As long as we've got good, solid foundations on products that will take us through the cycle, then I think the CLI story itself becomes one of resilience and diversification of risk.
Can I follow up?
Can I just add one thing based on what you said just before? It was just on the ROE component. So, so we were, yes, you're absolutely right. We were 5.5 last year. We are trying to get to a sustainable double-digit ROE, but it's going to take us a while. Because while the longer-term business model, as Andrew mentioned, is to be more asset-light, the truth is we still have a lot of assets on the balance sheet. So it's going to take us a few years for us to be able to divest and lighten the balance sheet and readjust to the fee model. So while we are trying to get to that double-digit, I do think and would ask that you be patient with us. It's going to take us at least 2 to 3 years for us to get there.
So just trying to focus on the numbers, right? So 10K, 20 million now. because probably operating, it's not fair to include the 33K units. So 126 times 20K, 20 million. So it's around there, that figure. Yeah. But as we scale, we should be able to go from 20 million for 10K units to about 25 maybe. Yeah. And I think another thing that you probably brought up during the restructuring and was actually, I read it in a Morgan Stanley report, was that you are able to do 70 basis points for every 70 basis point FRE for every FRE over AUM. Yeah. So 70 basis points. That's still something we look at because I was looking at the lodging business, 46 billion. It also works out to be something like that. Yeah. But is this kind of figures what we can look at when we scale, and is it something that we think is achievable?
Maybe just on the numbers. So, sorry, I'm not entirely sure which of the Morgan Stanley reports is. I think when most of them quote us, though, they quote us on our fee-related earnings for the lodging, for the fund management side, where we tend to be about 50 basis points to over FUM. So that's generally where we've been. As most of you, you know the REIT fee structures. Most of the REITs are, say, about 60 basis points to FUM. On a blended basis, because we have a lot of older private funds that were under market fee levels, we're at about 50. So we look at our fees based on the 50 basis points for funds under management. For the lodging side, I'm just trying to think what's the best way to guide. I think the easier indication might be, and I'm sorry we don't have it here, but if you look at our full year results, we always break down by our 4 verticals. And so you actually can see our lodging management fees, which I think for the full year were slightly over 200 million. If we're 228 million on lodging management fees, it gives you a better indication of how that ties to our number of units. So the fees themselves, the fees will generally scale with the number of units. If our number of units is 160,000 now, and say we get to 300,000, you should be able to scale our lodging management fees similarly. I think the difference on scale, as you mentioned, the benefits of scale is really the savings we get, right? So our margin will improve. So the total fee numbers, it should be able to estimate it based off the full year, give you a good indication of how that ties together. The part that we are not yet disclosing is our margin on the lodging business. We are discussing internally whether that's something we'll be comfortable disclosing. I mean, if you look at folks like Marriott or IHG, they tend to disclose their margins are 60 to 80%, excluding. We aren't there yet. I mean, their scale is tremendous compared to ours. I think publicly the only thing we've guided is that depending on how things are, we can be at about high 20s, 30% EBITDA margins. So I would say that's an easier way to look at how that growth might be, rather than what we guided during the restructuring, because we've changed the model a little bit. We have a lot more management contracts, so the numbers have adjusted slightly.
Yeah.
Thank you, Paul.
So since you are on this, right, I think this my questions are helpful, I think, because it is going to give the other shareholders some insight into the way you run your business. So for your FUM business, right, for your FUM business, could I have the first 4 verticals that you just said, just if the slides are available? And for your FUM business, you have 88 billion, you have 429 million, and that works out to, I think, 0.4875. That's 49 basis point.
I see how you're looking at it.
Yeah.
Understand.
So, but if we look at the listed fund, right, we have about 285 million FRE, and the FUM is 60 billion for the 6 listed REITs, right? So that works out to about 47.5 basis point. So the additional that is coming, the additional juice that is coming from the private equity part of the business and the private funds, which you say is under Stacy and the other one, Patrick is. The additional juice is just like 1 point something or less than 1 point something basis point. So is it because it takes about 6 years for a private equity fund to come to fruition, or how should we see this fund part of the business, and how long do we need to gestate to see some growth in that?
Yeah. Okay.
Because this relates to the business model, and I think a lot of us are very interested in how this thing will pan out. And this, I'm just asking some fundamental questions. Yep.
Yeah, and actually it's very good for us to give us a chance to explain. So we really look at it as, in terms of the fee, we have the listed business, which is obviously the easiest, the 6 REITs. You're right, last year it goes up and down, but it'll be about 50 basis points. Then we have the 2 private fund verticals, so the real estate and alternative assets. For the purposes of this, I would just collapse them together. It's just private fund fees. So private funds tend to have a lower base fee than the REITs. But what we count on is, say if you get 30 basis points as your base fee, what we count on is the carry component. So at the end of a fund, if we perform, say if the fund is supposed to target 12% returns, if we get 15% returns, we get a portion of the profits. So we call that the carry or the performance component. Usually on a running basis, that will pull the averages up for a private funds business potentially to 70, 80 basis points in total, because you can get a big swing there. It is true we won't get that on a run rate basis until a lot of the new funds that we've just started reach the end. Last year, we actually did recognize about 33 million of profit from carry, from performance, because some of our older funds did generate. So we still have some of the funds that were started before, we are recognizing some performance. So we get a little bit of swing there, but not a lot. So in terms of full run rate, seeing that total fee business go up, it will take us, maybe not 5, 6 years. We hope, over at least within 3 years, some of the earlier funds, we start to see some of that performance component come back. And then the last part is the lodging business. We separate those numbers completely because it's really quite a different business from a fee. So we don't look at that so much on a basis points of FUM. And we really look at it, as you would see, more just as a total a fee number for the lodging business.
Thank you, Paul. Yeah.
Hi, Zixian here. I just want to clarify, going from Vincent's one, for the private equity funds, right? Do you progressively recognize it, or you wait until the end of the fund, then you do it all at one shot? Because sometimes you might realize the thing during the fund life itself. Yeah. You sell off a building. So do you wait until all one lump sum at the end of the fund, or you progressively do it? Thanks.
So for our ownership stake in the funds, so if we have a private fund, we may own 20%, we would recognize any profit that is on the building itself. But in terms of a performance fee for the carry and the management, we only do that close to the end of the fund life. Maybe right after the closure or maybe the year before, if all the capital has been returned to investors already, then accounting-wise, we're able to recognize some of that. But it will generally be, I would say, would be beyond year 5 of the fund.
Hi, Paul, Manu. You mentioned Raffles cities in China, and that you had divested some part of that stake. I'm just trying to understand. So CLI versus CapitaLand Development. I mean, what is the ownership structure now, and what is the aggregate value of these Raffles cities, and what would be involvement of CLI as in, if they get, in terms of fee income, etc., managing the assets within them, because they are relatively large assets, right? So could you throw some color on that?
Yes. Yeah. Thanks, Manu. Thanks for being patient as well on the questions. So after restructuring, we have 2 separate entities. We have CapitaLand Development, which is our development arm, wholly owned by Temasek, and then we have CapitaLand Investment, which is the listed entity which we represent now. At that point in time, the assets were divided. Assets that were more development in nature or in progress, they were kept under CapitaLand Development. So we don't consider them necessarily part of our assets, though they may be future pipeline. But we do keep them distinct, and because they're privately held now, we also don't disclose their information. So I can speak at least for the CapitaLand Investment side. So what we have disclosed is in terms of gross asset value, and I say gross because in certain cases we don't own all of the building. We may own 50% or we may own 30%. So we have just over 10 billion worth of assets on the balance sheet for divestment, sort of gross asset value. 47% of that is China. A lot of that is Raffles City assets. So I would say from a gross asset value, we're just under or around 5 billion of assets for China that is potential pipeline for us that we could manage. So if, for instance, those 5 million, we're able to convert it fully to being managed by us, we would get a similar basis points, right? So if we charge fees on average, say 0.5%, we would earn 0.5% times the 5 billion of gross asset value.
So you still have a 5 billion stake CLI in
Our stake is less. In certain cases, we own 50%, so we don't disclose the precise amounts for each asset. But in terms of gross asset value, so ideally, we would like to manage the entire asset. So I would say it's up to 5 billion in China.
But are they all completed and have some of them been already securitized, as in under your private funds or?
No. So for the quantum that we are looking to divest in, they have not been securitized yet. Some of them are under development. So for instance, we have some, for example, we just put 2 of our data centers into a data center fund. Those were on our balance sheet with the intention of being pushed into the fund. So they are largely stabilized assets, but we do have the odd pocket here or two that are earmarked for specific funds that may be development projects.
Okay. Moving on, my other question was that in terms of like relatively low-hanging fruits for your FUM or for your investment management business, REITs and all that, have you looked at like the local listed groups like CapitaLand or Wing Tai and Guaco Land? I mean, they own quite prestigious assets either in Singapore, Australia, etc. And they don't actually have investment management like a REIT manager to manage their own assets, securitize them, etc. So is that something because they're quite substantial, these companies, and unlike at least City Developments, which has got its own asset management company to do, or the other groups that have done something, but these 3 groups have not done much, and they are at the moment, I mean, in the markets, their assets are quite undervalued, because you can't really see the value of the assets through a REIT or anything like that.
Yeah. So we definitely do. Not just actually the Singapore players, but we actually look at players in a number of other markets as well, particularly for sort of the mid-sized private companies. Is there a way that we can either, not just in real estate, but in other sectors as well, looking at, say, potentially like healthcare or as we did with self-storage, is looking for portfolios or companies that may. I have to say, generally, well, most folks that we discuss such opportunities with, they are happy to have a discussion with us or look for potential partnerships. Very, very few actually want to divest their assets. They're quite tightly held, even for a lot of the local mid-sized players. They like control and ownership of the asset. I think a lot of them don't like releasing that control either into a REIT or a fund because it constrains what you can do with the asset. So I would say a lot of the parties we have approached, it's not something that they're interested in doing. That's generally I would say the feedback we receive.
Okay, I'm afraid we have time for only 2 more questions because we need to move on to that.
Can we have a bit more Q&A time and less on the citizens tour, or we can actually overshoot on that? Because
What time do we have to?
That's 1:30. But actually, after this, if you'd like to stay back to ask some questions, yeah.
A lot of us feel that this engagement is actually a very fabulous idea, and this CLI thing is a very new thingy, and we really need time to try to understand this.
Maybe we could talk over lunch.
Yeah, absolutely.
We can just eat the bentos and then talk like that.
So then give us another half an hour. Okay.
Sure. Maybe we finish with this 2 more questions first. Yeah.
I try to follow up with.
So I think Vincent, maybe for those people who have questions in the formal forum, let's get those questions done, and then for those who want to stay behind and have a chat while we eat, such as yourselves, Manu, we can do that later, But let me just check to see if there are any other questions from anyone else. If not, we'll take your question. So, yeah.
Yeah, I'll go ahead.
Thanks.
Sure,
Vincent.
go ahead.
Yes.
Hi, Gerald here. Thank you for your time again. Just have a couple of questions on the private fund business.
Yes.
Because obviously it's a future driver for growth for the group, but something new for retail investors. So it's good to understand a bit more this segment. Just to clarify, so you mentioned that now if we talk about the Chinese market, which is a big market, it is more for the Chinese investors, the domestic investors. Because I remember that 2 years ago, the good story was, given our expertise on the Chinese market, that we could bring some international investors to this market. But it seems, what I can understand, that the appetite from these big institutional investors from the West, maybe, now for China is not that great. So, could you confirm that in a way, your new strategy, your new positioning for China is to target more the domestic investors? And in a way, what is our competitive edge for that? In other words, why would Ping An give to CLI some funds to manage and to buy Chinese assets? In terms of competitive positioning, where are we now?
That's a great question.
And maybe the last question is, what is the appetite from all these big investors from the West now in Asia? Because what are we going to do with them? Is it Korea, Australia? But obviously much smaller markets. So just to understand the articulation.
Okay, like all your questions these days are multi-part questions.
Sorry about
that. The US dollar China market is effectively closed at this point in time. There are a handful of investors who are contrarians and still tell us we can invest in China. But I would say that if you're talking to a US investor today, a California pension fund, Texas teachers, the Canadians, 90% of them will tell you, I may like the idea, I may even like the returns profile, but politically I cannot invest in China. My senator is telling me, my mayor is telling me, my pensioners are telling me no to China. So you're absolutely right. We've had to readjust the capital pool of where we're going to get this capital to invest in these asset ideas and portfolio ideas that we continue to originate, to your second question, because we have boots on the ground. And this was very clear to us during COVID, when people couldn't travel. And when you can't travel, you can't fly into China to kick the tires, to go and look at buildings. And any good investor will tell you, you must not buy sight unseen. You must go and look at the building, walk the building, feel the bones, talk to the owner, understand what the situation is. If you're unable to do that, effectively for 2 years, 3 years, nothing can get done. What's our advantage? Our advantage during that time was that we had teams in Shanghai, Beijing, Chengdu, Chongqing, Shenzhen, Guangzhou. We can, presuming you're not locked up in your house, which we were for a while, but when that changed, we could at least travel within the country. And that allowed us to assess what the investment opportunity set was going to look like and get a head start on what is interesting, what is investable, to provide ourselves with an opportunity set. So that was a huge advantage. And I think now we are in a place where we can reap the benefits of that. So we have a problem now. We have an opportunity set that we are able to curate, but we don't have the capital pool, because the capital pool is telling us not now. So we've had to look elsewhere to match the capital pool with the opportunity set. And the most obvious, sensible place is let's stay in China, where there's an ample pool of liquidity and capital that's looking for people who they can trust and people who can manage their money and generate a fair return. And the other interesting thing that shows up is these people don't have FX issues. They're not worried about what the renminbi will do against the dollar. They're not worried about whether they can take the money in and out. They're not worried about geopolitics because they're all in the same country. So the reality is actually by almost forcing us to look more inward for the capital pool, we actually came across a very nice match of capital with opportunities. So that's, I would say, the silver lining in what was a very dark cloud when all of our US capital partners says, thanks, but we can't invest in China right now. Now that may change. So again, we have to be nimble and be ready, right? But
I understand the opportunity, but what about the long-term strategy for China? I mean, is it something that you can continue to develop, targeting these domestic investors?
It's very, very deep very, very deep investor base that's only now starting to realize what is available out there in terms of securitizable product. So you ask us also, what is the advantage? Why would Ping An put money with us? It's a funny thing, and it's a little bit sensitive, but there is also a lot of internal competition inside China. So if I'm one SOE, I will never hire another SOE to manage my money. It will never happen. So a lot of the time, they look for an honest broker that they can trust. And I'm grateful to say that I think over the years, CapitaLand, the brand of CapitaLand stands for somebody who's an honest broker who doesn't really have an agenda. I'm here to deliver a fair return for you. I have the highest standards of governance. I'm not influenced by things in country that maybe other local partners might be, right? Without getting into too much detail. So that actually puts us in a very nice, neutral position to manage capital for different partners in China, such as the Ping Ans of the world. Now, it's not easy. They are hard LPs. They are high maintenance LPs. China also has its own set of rules. It's not an S-REIT space by any means. It's its own set of rules that we have to be mindful of, and also be aware of who your counterparty is. So don't get me wrong if I say, this is checks all the boxes, no FX, no anything easy doing. It's tough, and there's its own set of risks that we have to be very mindful of. So at the end of the day, from a strategy perspective, it's all about making sure we are well diversified. If you put too much into China right now, whether it's RMB or US dollar, it gets to a point where you feel uncomfortable because you never know what happens. We don't know what is out there. If the last 12 months has taught us anything, is you don't know where the next crisis is coming from, right? So you are fooling yourself if you think, okay, I have full visibility of the risk set and the risk spectrum. I got it covered, because every month there was almost a new crisis, and you have forced to pivot, forced to re-look at your strategy, forced to reset and continually iterate your way through the strategy. So we could be having a very different discussion by the time AGM rolls around. And if you ask the same question, please don't quote me today, because it might be very different. I hope it isn't, and we hope some stability comes back to our business, but I honestly would not be surprised if this ultra-high VUCA environment keeps us on our toes and keeps us having to re-look and recalibrate the strategy going forward. But are we long China? We're absolutely long China. Do we think China is investable? We absolutely think China is investable. We just have to be smart about the different products, the different capital pools we manage, and the overall exposure, which is why places like Japan, Singapore, Australia, Korea become very important to us, just to balance the terms of
So for the international investors, where is the appetite now? In which geography do we see the demand?
Okay, the separate question is, generally most international investors are very concerned about commercial real estate, particularly office in developed markets. Because I think, as you all have read, interest rates are going up faster than rent growth, and we might even be tipping into a recession. So when that happens, and you have typically negative capital value reversion, so there is a lot of refinancing coming up. When loans which were taken out at very low interest rates have to be refinanced at higher rates, automatically this drops straight to the bottom line. Your borrowers get nervous. Can you service the debt at these elevated levels? If we manage to avoid a recession, that will be very helpful. People, at least, that means we're talking about GDP growth, we're talking about potential rent growth, and so on and so forth. But if we find ourselves in the midst of a severe recession, then you've got negative rent growth at a time when interest rates are going up. That's not really a good story when it comes to investing in real estate. So our strategy right now, honestly, is to keep quiet, lie low, wait to see how things develop. And if asset prices start to come down, that's the time when those who have dry powder, who are not over-leveraged, can really invest for a very nice, productive next 3 to 5 year cycle. If you go back in history, the REIMs that really outperformed were the ones that made the smart investment decisions during times of crisis and therefore opportunity. So if you listen to Chico, and Chico will tell you, right now, there's no rush. No rush to go and spend money right now. Let's keep our eyes open, understand the investment landscape, be ready with our vehicles, with our capital partners, demonstrate thought leadership. This is where the secular trend is, whether it's aging demographics, whether it's travel, whether it's ESG. These are secular mega trends. Be ready to invest into those trends, but tactically wait for the right time, because in the next 12 months, there's a lot going on that could really affect asset prices. So we'll be absolutely opportunistic, but at the same time, careful about not spending too quickly. I hope that helps. Paul, I think wants to say something.
No, I was just going to add, I think specifically on when you asked on which of the countries investors are looking at, I think generally institutional investors are still very keen on Singapore. It's seen as a good, stable market. So we get a lot of positive interest. If you're looking to sell assets, there's always interest for Singapore. Japan is still doing well, generally as a market, because the low interest rates and, particularly I guess recently with the bank governor of Japan making comments that it seems like it's going to stay, we still see interest in Japan. In fact, we ourselves, through our core open-ended fund, one of our private funds, we just acquired assets, multifamily assets in Japan. So I think that market is holding its value. Korea still sees some interest because it's a smaller market, a bit less so. I would say for the rest of Asia Pacific, they're much more cautious.
Thank you, Paul. Thank you, Andrew. I'm sorry. I'm afraid to let you know that due to time constraints, we have to move on to the next part of the program. I know many of you have questions, so maybe just hang around. But for now, we've prepared some food at the back. You can take your food and actually eat it in the garden oasis. You can enjoy the view of the garden, can explore it a bit. And of course, I mentioned the Citadines property tour later on. If you're interested to join, please come back at, there's a lift over there. Please gather there at around 1:25 p.m. Yeah.
I think Paul and I are quite happy here. So those of you who want to...
That's right. Yeah, so for those of you who would like to stay and chat more, you're welcome to grab lunch and sit here. Andrew and I are just going to stick around here, so please feel free. We'll be here till 1:30 till the tour starts. So.